1 minute ago, the order went live. No press conference, no dramatic speech, just a quiet bureaucratic notice that may end up costing the United States billions of dollars a week. If you're watching this right now, you are witnessing what could become the most expensive miscalculation of a presidency. And this time, there's no tweet, no rally, no last-second spin that can reverse it. Because as of this morning, the rules of the sky have changed. For decades, American airlines have flown north without thinking twice. Cargo jets, passenger planes, military transports, all carving smooth arcs over the Canadian Arctic on their way to Europe and Asia. It was efficient, it was fast, it was profitable, and it was built on a single assumption, that Canada would always keep the door open. That assumption just shattered. Canada has revised its overflight fee structure and restricted access to key polar routes for nations engaged in hostile trade actions. That may sound like paperwork. It isn't. It's leverage. And the fallout is already rippling through airline stocks, logistics networks, and global supply chains. Flights that used to glide over the top of the world now have to reroute. Time is being added. Fuel is being burned. Costs are stacking up by the hour. This isn't just a policy tweak. This is the map fighting back. And before this day is over, it could hit your plane ticket, your online orders, and maybe even your portfolio. The question is, how did it get to this point? And why does it feel like it happened overnight? Hi, I'm Susan. I cover the intersection of politics, economics, and the systems that quietly keep our world running. And today, one of those systems just shifted in a way most people won't understand until it shows up in their bank account. In this video, I'm going to break down exactly what Canada changed, why it matters far beyond aviation, and how this escalates the ongoing trade conflict into something far more strategic. Because this wasn't an emotional outburst. It wasn't a symbolic protest. It was calculated. And when you understand the geography, the physics, and the economics behind it, you'll see why this moment could redefine the balance of power in North America. Let's strip away the noise and look at what actually happened this morning, and why the consequences may be much bigger than anyone in Washington expected. At exactly 8 a.m. Eastern Time, Transport Canada issued a notice to air missions. No dramatic headlines, no emergency broadcast tone, just a procedural document stating that preferential overflight rights previously granted under long-standing agreements were being suspended pending a sovereignty and environmental review, specifically for nations currently engaged in hostile trade actions. That's the language. Calm, technical, almost boring. But inside the executive suites of major U.S. airlines, it landed like a detonation. Here's the geography lesson that suddenly matters to every American traveler. When you fly from New York to Tokyo, the plane doesn't trace a straight line across the flat map you remember from school. It curves north. It arcs over the Canadian Arctic, hugging the top of the globe where the distance is shortest. That polar route saves time. It saves thousands of gallons of jet fuel. It allows airlines to operate non-stop long-haul flights that would otherwise require refueling stops. It's not optional efficiency. It's structural efficiency. It's how the math works. And now that math has changed. Without preferential access through Canadian airspace, U.S. carriers face two options: pay sharply revised overflight fees that dramatically alter route economics, or reroute entirely, flying south, adding hours, increasing burn rates, and in some cases requiring technical stops in places like Anchorage or even Hawaii. Add hours and you add fuel. Add fuel and you add cost. Add cost and suddenly routes that were profitable become razor thin or unsustainable. Crews hit legal work time limits. Aircraft rotations fall apart. Scheduling cascades through entire fleets. One disrupted polar route doesn't just affect one flight, it echoes across dozens of connected departures. Early analyst estimates this morning suggest the U.S. aviation sector could absorb up to $4 billion per week in additional operational costs if the current structure holds. $4 billion per week. That's not a tariff headline. That's a structural shock. And here's where it gets even more uncomfortable. There is no immediate legal mechanism for Washington to force reversal. Canadian airspace is sovereign territory. Sending military aircraft to ignore the policy would be an act of war. Filing suit in U.S. courts is meaningless. The leverage rests entirely with Ottawa. So why now? Why pull this lever today instead of months ago? Because leverage works best when it's timed against assumption. For months, the administration escalated trade pressure, tariffs on steel, aluminum, lumber, under the belief that Canada would absorb the blows, that the relationship was too integrated, too friendly, too historically cooperative to fracture in a meaningful way. The assumption was that political pressure would outweigh geographic reality. But geography doesn't negotiate. Geography doesn't tweet. Geography simply exists. And today it was weaponized with paperwork. This is where the contrast becomes impossible to ignore. On one side, a strategy built on public confrontation, tariff escalation, and rhetorical dominance. On the other, a response built on systems thinking, change the cost-benefit equation without raising your voice. If tariffs make Canadian goods more expensive for American consumers, then adjusted overflight access makes global commerce more expensive for American carriers. Action, reaction, equal and opposite. Markets are already responding. Airline stocks opened sharply lower. Logistics firms issued updated guidance warning of route volatility and fuel cost exposure. Cargo carriers are recalculating schedules in real time. And there's another layer that hasn't fully hit yet: international competitors. Asian and European airlines that are not subject to the same revised conditions can continue flying efficient polar routes at standard rates. That means a Korean or Japanese carrier could potentially deliver passengers or cargo to North America faster and cheaper than a U.S. airline operating under new constraints. This isn't just about increased costs. It's about competitive displacement. And here's the part that makes this especially difficult for Washington. There's no clean counterpunch. Ban Canadian airlines from U.S. airspace? That would disrupt cross-border travel immediately. And Canada's geographic position still allows its carriers efficient access to Europe and Asia without relying on U.S. corridors in the same way. Escalate tariffs further? That invites broader retaliation across energy, resources, and supply chains. The usual playbook, aim, pressure, threaten, escalate, suddenly runs into structural limits. The silence this morning is telling. Normally, when confronted with a challenge, the response is immediate and loud. But structural leverage isn't easily shouted down. Lawyers are reportedly combing through decades-old aviation agreements. Advisors are evaluating retaliatory options. But the underlying reality remains. The United States assumed uninterrupted northern access as a baseline condition of global trade. That baseline just shifted. And if you're wondering whether this really affects you, whether this is just an airline boardroom problem, stay with me. Because the ripple effects don't stop at airport runways. They extend into shipping costs, manufacturing timelines, ticket pricing, and potentially much further into energy and infrastructure. The sky may seem distant, but the bill, if this continues, will feel very close to home. Now let's talk about what this looks like in the real world, not on a policy memo, because the stress fractures are already forming. One of the first pressure points is anchorage. On paper, Anchorage has always been a strategic asset, a refueling hub positioned perfectly between North America and Asia. In practice, it was never meant to absorb a sudden surge of rerouted long-haul traffic trying to avoid higher-cost northern corridors. As U.S. cargo carriers begin diverting, the airspace narrows. Arrival banks stack up, fuel demand spikes, ground crews stretch thin. What used to be a smooth transpolar arc becomes a funnel. And funnels create bottlenecks. Every additional minute on the ground is money burning. Wide-body aircraft don't sip fuel. They consume it at staggering rates. Crews time out under federal regulations. Maintenance windows shift. Aircraft rotations that were optimized months in advance suddenly collapse like dominoes. And when one long-haul segment shifts by 2 or 3 hours, it doesn't just affect that route. It knocks off downstream departures across entire fleets. The aviation system is interconnected. Tug one thread and tension spreads everywhere. But here's where the competitive dimension becomes even sharper. Not every airline is absorbing the same disruption. Asian carriers, European carriers, airlines not caught in the same trade crossfire, continue operating efficient northern routes under existing frameworks. That means their cost structures remain relatively stable, while U.S. operators face rising burn rates and schedule inefficiencies. In a global marketplace where margins are already tight, that difference matters. A foreign carrier that can move cargo faster and cheaper into North America gains share. Business travelers booking international routes notice price gaps. Freight forwarders notice reliability gaps. Over weeks, not months, those shifts compound. And then the ripple reaches you, because higher operating costs do not stay inside airline accounting departments. When fuel consumption rises, surcharges follow. When route profitability narrows, seat capacity gets trimmed. Reduced capacity pushes ticket prices upward. A non-stop flight that was once affordable becomes a premium product or disappears entirely. Summer vacations, business trips, family visits, they all feel the adjustment. The same applies to cargo. If a FedEx or UPS aircraft now requires longer routing or additional stops, shipping costs rise. Retailers pass those costs forward. The extra few dollars on a package here, the slightly higher price on electronics there. It doesn't announce itself as geopolitics. It just shows up on your receipt. And this is where the conversation shifts from aviation to economics. Modern supply chains operate on precision timing. Components manufactured in Asia arrive within narrow windows to feed production lines in the United States. Add even a day of delay, and inventory buffers start thinning. Manufacturers compensate by increasing safety stock, which increases warehousing costs, which increases prices. Or they slow production. Slower production can mean fewer shifts. Fewer shifts can mean pressure on jobs. What begins as an airspace adjustment becomes an economic multiplier. This is the invisible tax of strategic miscalculation. Not a headline tax voted through Congress, but a cost embedded quietly into logistics, energy, and transport. You may not fly to Tokyo, you may never set foot on a trans-Pacific route, but you do live inside an economy that depends on them. And there's another layer that hasn't fully entered public discussion yet: signaling. When a country demonstrates it can leverage infrastructure rather than rhetoric, other nations pay attention. Airspace today, energy tomorrow. Canada is one of the largest suppliers of crude oil to the United States. It provides significant electricity flows across shared grids, integrated pipelines, cross-border transmission lines, rail networks, all built on cooperation. No one is suggesting those systems are about to shut down. But the reminder is clear. Interdependence runs both ways. At this midpoint, it's worth pausing for a second. If you're finding this breakdown helpful, if understanding the mechanics behind the headlines matters to you, take a moment to support the channel. These deeper dives take time, and your engagement helps keep them coming. Now let's keep going, because the next 24 to 48 hours could determine whether this stabilizes quietly or escalates into something far more disruptive. The strategic question now is simple but volatile. What happens next? Because structural leverage creates pressure, and pressure demands response. There are limited pathways forward, and none of them are painless. One path involves de-escalation, trade tensions eased, tariffs reconsidered, rhetoric softened in exchange for normalized aviation terms. That would calm markets quickly, but it would require political concession. Another path involves retaliation, reciprocal restrictions, additional tariffs, symbolic escalation designed to project strength. That route satisfies short-term political optics but risks amplifying economic damage. And then there is the third possibility, the quiet negotiation, the off-camera envoy, the behind-the-scenes recalibration where public language remains firm while private agreements adjust terms enough to restore operational normalcy. Historically, that's how many trade confrontations conclude, not with dramatic reversals, but with incremental concessions, both sides can frame as victories. Which direction is chosen will depend on how decision makers interpret the costs unfolding in real time. Airline executives are already running updated projections. Market analysts are recalibrating sector risk. Energy traders are watching closely, because if aviation access can be leveraged this effectively, it reframes assumptions about what tools are available in modern trade disputes. And that's the broader lesson emerging here. Global power isn't just about military strength or headline tariffs. It's about choke points, infrastructure, geography, the quiet systems everyone assumes will remain neutral. When those systems become strategic instruments, the balance shifts. We are watching that shift happen in real time. To understand how serious this could become, you have to zoom out beyond airplanes and look at the full architecture of North American interdependence. The United States is not an isolated island economy. It is deeply, structurally connected to Canada through energy pipelines, electricity grids, rail corridors, and raw materials. Canada is one of the largest foreign suppliers of crude oil to the U.S. It feeds refineries in the Midwest and along the Gulf Coast. It transmits hydroelectric power across shared borders into American cities. It ships critical minerals used in manufacturing, defense, and technology. None of that has changed today, but what changed is the perception of limits. When a government demonstrates that it is willing to leverage airspace and one of the most sensitive arteries of globalization, it sends a signal that other forms of leverage exist. Again, this isn't about imminent shutdowns. It's about negotiating power. Trade disputes used to revolve primarily around tariffs and quotas. Now they revolve around choke points. And choke points, once activated, are hard to ignore. There's a phrase often used in economics: consumer nation versus supplier nation. The United States consumes enormous volumes of energy, goods, and transport capacity. Canada supplies a meaningful portion of those inputs. When friction rises between a consumer and a supplier, both sides feel pain. But the side dependent on uninterrupted flow often feels it faster. That's the uncomfortable reality policymakers are now recalculating in Washington. And here's where the clock matters. The first 24 to 48 hours in a standoff like this are critical. Markets are emotional early. They price in worst-case scenarios quickly. If signals of negotiation appear, volatility stabilizes. If rhetoric escalates, volatility compounds. That's why the response from the White House over the next day will be closely scrutinized, not just by airlines, but by energy traders, logistics firms, and international investors. So let's walk through the three realistic scenarios on the table. Scenario 1, de-escalation. Trade tensions cool, tariff policies are adjusted or paused, diplomatic language softens. In exchange, aviation access normalizes under revised terms both sides can publicly frame as responsible governance. Economically, this is the cleanest path. It restores stability quickly and limits long-term damage. Politically, however, it requires someone to concede ground, and concessions are rarely celebrated in high-stakes trade disputes. Scenario 2, escalation. Retaliatory measures expand. Additional tariffs are introduced. Symbolic restrictions are announced to project strength. In aviation terms, that could mean reciprocal constraints or bureaucratic friction applied to Canadian carriers. The problem with escalation is symmetry. When two integrated economies harden simultaneously, friction multiplies. Business travel slows, cross-border commerce tightens, investor confidence weakens. Escalation may satisfy political narratives in the short run, but economically it increases the probability of contraction, and contraction doesn't respect national pride. Scenario 3, the quiet deal. Publicly, both sides maintain firm postures. Privately, envoys shuttle between capitals. Adjustments are made in technical language, environmental standards here, fee recalibrations there, until operational normalcy returns without either government explicitly declaring retreat. Historically, this is how many disputes conclude, not with dramatic speeches, but with revised paperwork. The uncertainty lies in which scenario leadership chooses and how quickly, because every additional day of disruption reinforces competitive shifts already underway. Remember those foreign carriers operating unaffected northern routes? The longer U.S. airlines face structural disadvantages, the more customers experiment with alternatives. In global aviation, loyalty can change faster than expected when reliability shifts. There's also the broader international lens. Other nations are watching closely. Trade negotiations around the world increasingly hinge on strategic dependencies: ports, shipping lanes, semiconductor supply chains, rare earth minerals. If this episode proves that infrastructure leverage can rebalance a dispute quickly, it becomes a case study. Not necessarily for confrontation, but for negotiation positioning. Power in 2026 isn't just loud, it's logistical. And this brings us back to the human layer. The airports, the families, the businesses trying to make decisions in real time. Imagine the departure boards flickering with delays as routing plans adjust. Imagine small exporters recalculating shipping contracts. Imagine travel planners watching fares shift overnight. These are not abstract macroeconomic charts. They are lived disruptions. At the same time, inside government offices, teams are running scenario models. What does a 2-week standoff cost? What does a month cost? At what point do airline CEOs apply direct pressure? At what point do market losses outweigh political optics? These are the questions shaping the next move. Because here's the underlying truth. Interdependence is powerful, but it is also fragile when politicized. The modern global economy runs on trust in invisible systems. That airspace remains open, that shipping lanes remain neutral, that contracts outlast rhetoric. When one of those assumptions is challenged, even temporarily, it forces everyone to reassess risk. The sky for decades felt neutral, apolitical. A shared highway above borders. Today, it became strategic territory. And once a highway becomes a bargaining chip, future negotiations never look the same. We're not at a conclusion yet. We're at an inflection point. The next signals, whether conciliatory or confrontational, will determine whether this becomes a short-lived shock or the beginning of a more structural realignment in North American trade dynamics. And that final question now hangs in the air. Who blinks first? If you step back and look at the broader picture, this moment is bigger than aviation and bigger than a single trade dispute. For decades, the power dynamic on this continent followed a predictable rhythm. Washington applied pressure, Ottawa adjusted. The assumption, sometimes spoken, often unspoken, was that scale determined leverage. The United States was larger, louder, economically dominant. Canada was cooperative, pragmatic, rarely confrontational. That historical rhythm shaped expectations on both sides of the border. But leverage is not just about size, it's about position. Geographically, Canada sits across the top of the hemisphere. It is the roof of North America. The most efficient air corridors between the United States and major global markets arc across that roof. Energy flows south. Electricity crosses quietly through transmission lines most people never think about. Rail and trucking routes weave across a border that, until recently, symbolized stability more than friction. When that architecture functions smoothly, it feels invisible. When it becomes contested, it becomes unmistakable. And that is what makes this episode so consequential internationally. Europe is watching, Asian markets are watching, trade ministries around the world are watching how a middle power leveraged geography rather than rhetoric to counter economic pressure. Not because they seek confrontation, but because every nation recalculates its own dependencies when a precedent is set. If infrastructure can be activated as leverage once, it can theoretically be activated again. This is how global norms shift. Not with dramatic declarations, but with technical adjustments that reveal new boundaries. The lesson emerging isn't that airspace should become weaponized. The lesson is that interdependence cuts both ways. When policymakers assume access is guaranteed regardless of political strain, they underestimate the quiet power embedded in logistics. Now bring it back home for a moment. Imagine the scene at major hubs, departure boards blinking amber and red, gate agents fielding frustrated questions, travelers refreshing apps hoping for updates. That frustration doesn't announce itself as geopolitics. It feels like inconvenience. But behind every delay is a recalculated route, an adjusted fuel load, a cost sheet being revised somewhere in a corporate office. Behind every stock dip is an investor reassessing risk exposure. Behind every price increase is a spreadsheet compensating for new friction in the system. And here is the irony woven through all of this. Policies often framed as strengthening national leverage can, under certain conditions, expose structural vulnerabilities instead. Efforts to pressure a trading partner can reveal how deeply integrated supply chains have become. Moves designed to project dominance can trigger responses that highlight dependency. None of this unfolds in campaign slogans. It unfolds in logistics models and cost analyses. As the day continues, narratives will compete. Some will frame this as justified defense of sovereignty. Others will frame it as unnecessary escalation. Analysts will debate legal interpretations of aviation agreements signed decades ago. Markets will swing on rumors of back-channel talks. But beneath the noise lies a simpler reality. The global economy runs on cooperation more than confrontation. When cooperation fractures, even briefly, costs multiply quickly. So where does that leave us tonight? It leaves us at a crossroads defined less by emotion and more by arithmetic. If cooler heads prevail and negotiations accelerate, this could settle into a cautionary episode, a sharp reminder that interdependence requires restraint. If escalation continues, even incrementally, the consequences widen. Aviation costs feed into shipping, shipping feeds into retail pricing, energy markets grow cautious, investment slows. Confidence, that fragile but essential economic ingredient, begins to thin. The defining question isn't about who delivered the sharper statement or who appeared stronger on television. It's about who understands the system well enough to stabilize it. Because in a tightly connected continent, destabilization rarely remains isolated. It travels. The skies above North America have long symbolized openness, trade routes stretching outward, opportunity crossing oceans, movement without visible walls. Today, those skies became a reminder that openness is maintained, not guaranteed. Agreements matter. Assumptions matter. Geography always matters. And as we watch the next moves unfold, whether through negotiation tables or public podiums, remember this: the cost of misjudging interconnected systems doesn't stay abstract for long. It finds its way into fuel receipts, freight contracts, and household budgets. This is not just a story about airspace. It's a story about leverage, dependency, and the delicate balance that keeps modern economies functioning. The map hasn't changed, the physics haven't changed, but the understanding of power just did. What happens next will determine whether this becomes a brief disruption or the moment North America's economic relationship quietly recalibrated.